When people hear the word options, they usually think of something advanced or dangerous, like a tool reserved only for experts or Wall Street. But the truth is that options are built on a very simple idea. They give you the right but not the obligation to buy or sell something at a specific price in the future. Once you understand that one sentence, options stop feeling intimidating and start making perfect sense. Let's make it real with a simple story. Imagine you want to buy a house, but you're not ready yet. You tell the owner, I'll pay you $300,000 if I decide to buy it within the next 3 months. Here is a $5,000 to hold that price for me. If the house value rises to $330,000, you buy it at the original $300,000 price, and you are instantly ahead. If the price falls or you change your mind, you simply walk away. You lose the $5,000 fee, but you are not forced to buy anything. That agreement you just made, that's an option. In trading, there is only 2 types of options. A call option is the right to buy something at a specific price. A put option is the right to sell something at a specific price. Options are contracts tied to an asset like stocks, indices, commodities, or even crypto. Each contract has 3 main elements: the strike price, the agreed price, the expiration date, and the premium, which is the fee you pay to buy the option. Now, let's break down how traders actually use them. A call option increases in value when the asset price goes up. It's like predicting, I think the price will rise above this level before the option expires. A put option increases in value when the asset price goes down. It's like predicting, I think the price will drop below this level before the option expires. But here's the beauty of options. You don't need to buy the stock to profit. If you buy a call option and the stock rises, the value of your option goes up. You can sell the option contract for profit without even touching the stock. It's like renting the right to buy and then selling that rental contract to someone else before it expires. And just like a house example, if the market moves against you, you are not obligated to buy or sell anything. The option simply expires worthless, and your loss is limited to the premium you paid. That's one of the reasons many traders like options. Limited risk, unlimited potential upside, especially with calls. But options aren't just used for speculation. They're also used for hedging, protecting investments. Imagine you own $10,000 worth of Tesla stocks, but you're worried it might drop next month. You can buy a put option to protect yourself. If Tesla falls, the put option increases in value, reducing your losses. It's like buying insurance for your portfolio. Options can also generate income. Some traders sell options to collect premiums similar to earning rent from a property. These strategies can be conservative and powerful when used correctly, but they come with obligations, because when you sell an option, you become the one granting someone else a right, and that requires more knowledge and risk control. Let's go deeper and connect options to something you already know: probabilities. Options pricing reflect the probability of an asset reaching the strike price before expiration. The further the strike from the current price, the cheaper the option, because the probability is lower. The closer the strike, the more expensive the option, because the chance of hitting it increases. But options also have something special called time decay. Options lose value as they approach expiration, even if price doesn't move. That's because the chance of hitting the strike decreases as the deadline approaches. Time decay is why many beginners lose money with options. They underestimate how fast premium erodes. Here's an easy analogy. Imagine you buy a coupon that expires in 1 week. Every day that passes without using it, the coupon becomes less valuable. Options work the same way. Time is part of the price. options also become extremely interesting when combined with smart money concepts. They respond to liquidity graphs, volatility expansion, news, and institutional behavior. A strong displacement can rapidly increase options value. Imbalances and liquidity pools tend to create volatility pockets, and options pricing react immediately. Let's tie everything together with a simple real scenario. You believe Apple's stock will rise from $180 to $190 soon. Instead of buying the stock, you buy a call option with a strike at $185. You pay a 3 premium. If Apple rises above $185, your option increases dramatically in value. Maybe it goes from 3 to 8. You can sell the option contract and profit without even buying Apple shares. If Apple stays under $185, the option expires and your loss is capped at 3 per share. That's the entire risk. So to summarize, options are contracts that give you the right but not the obligation to buy or sell something at a set price before a deadline. A call equals a right to buy, and a put equals a right to sell. They offer leverage, limited risk, hedge power, and flexible strategies, but they require understanding of time decay, volatility, and pricing. Options aren't magic. They are simply tools, powerful ones that let you trade risk, time, and probability in ways that stocks alone can't. Once you understand how they work, you realize they're not complicated, they're just different. And that difference opens the door to a world of new strategies and possibilities.